So hi, my name's Roy Thompson. I head up Carpenter Box Financial Advisors. With me is Henry Wilson from LGT Wealth. Henry is an investment manager, and this is a series of At the Coalface. We've done a number of these before, just trying to compare what really is going on in the economic world with compared to perhaps what you might read in the press. Clearly dominating the press over the course of the last, well, probably a year or more now, is the notion of inflation. I think in the last week or two, we've seen some varying outcomes with inflation figures in the US, surprising on the, I guess you say, the downside. So it's coming down, inflation coming off at a slightly quicker rate than expected compared to in the UK, where the inflation story is proving to be very stubborn. So, Henry, just thinking about those 2 points, any sort of key reasons why that is, and how's that affected those sort of underlying markets?
Yes. So on the US front, clearly been good news and very much we would say moving in the right direction, albeit being a bit more slow paced perhaps than people would have expected. On the whole, this kind of downwards normalization, as it were. But on the whole, the US is moving in the right direction, and that's been quite encouraging. Markets have been quite kind of buoyed by that. In the UK, inflation remains very much more sticky than people expected, and that's not just looking at headline inflation, but it's also looking at the core inflation.
Yeah,
Core inflation basically strips out the kind of more variable components, the components that are outside of the central bank's control, things like energy prices or things like that, that just food prices that move out of their control. Now, both headline and core have been kind of surprising in the UK, and that's been the main impact that's caused. It's meant that interest rates are now looking like they will go higher and for longer than people expected.
yeah,
Now that's had a knock-on impact into markets. It's meant that kind of UK gilts have suffered quite a lot as people kind of realise that inflation will be higher and yields will have to go higher to kind of compensate for those higher inflationary rates. But the big reason for the UK inflationary issues is that we have a number of structural issues in the UK at the moment. Some of it is related to Brexit and some of the tightness in the labour market and supply chain disruption. Some of it is related to the Russia and Ukraine crisis, where supply chain disruption meant that the time to get things delivered has increased, but also the cost of delivering things and the cost of buying things. But also some of it is to do with some UK specific issues, such as post-COVID, we have around 700,000 to 1 million people that are on long-term sick leave. The government has launched an official investigation to find out why this is the case. But we don't, it's all kind of conjecture at the moment and guesswork. But what it does mean is that is clearly contributing to the tightness of the labour market. If you have 700,000 to 1 million people that can't work at a time when the labour market's already quite tight, that's clearly not helping things. Finally, in the UK versus somewhere like the US in particular, we don't we don't produce a lot of our own energy on our own shores. We rely on imports quite a lot. And the same can be said for things like food and other kind of food produce. So we rely on importing a lot of those types of things, whether it's fertilizer or gas, electricity, key commodities, etc. Whereas in the US, they basically manufacture or produce a lot of that on their own shores. So we're very much more at the whims of outside events, like external events such as Russia and Ukraine, or a one-off supply shock that comes from COVID, etc. We do think, however, that in the UK things will eventually normalise. It just might take a little bit longer. And one of the good examples of that is that when we get the July CPI inflation print in August, we think that will show a one-off decrease of around 20% in our energy bills, and that will clearly immediately impact our inflationary figure, the CPI figure. So definitely much more sticky than expected, and that's why the Bank of England's had to come out with some quite stern messaging around raising interest rates. But we think that eventually, both in the US and the UK, they will have to bring it down, because it's not palatable for people to have inflation rates that are so high.
But for sure, but interesting listening to you that you would have imagined with some of those outside influences, none of them are easy to resolve, and certainly not resolvable in the short term. I guess if people are listening and perhaps following that, the expectation might be that inflation, yes, it could come down, but the notion of it getting back to 2%, that seems a far cry just at the moment. Some people would be sort of saying, well, maybe we do need a recession, particularly unpopular. I accept that's a really unpopular statement. But without something like that, it certainly feels to me that inflation will be very stubborn, because some of those structural issues you discuss they're not issues you can resolve in the short term.
Completely agree with that. If you take something like the labour market, which has been one of the big drivers of the inflationary pressures that we have here, and one of the reasons why wages have been rising so quickly, the only way really to stop that issue in particular is that you really slow down demand. And the best way to slow down demand is to essentially bring on a recession. And the one thing I would say about recession is everyone gets very afraid when you say that word and they think back to 2007, 2008.
Yes.
We think that actually you can have a less dramatic recession, one where you do have a slower period of economic growth, 2 quarters of negative, albeit it might be a small technical kind of 2 technical periods of slower economic growth that causes a recession. But it doesn't have to mean, a global financial crisis or anything like that. In fact, we actually think the banks are pretty well, they're well capitalized these days. The regulation is much stronger around them. So we don't envisage that type of scenario. But yeah, I wouldn't rule out that in particular for the UK that we will have some kind of slowdown either early next year or over the next kind of 1 year, let's say. The impact of higher interest rates, particularly if in the UK it ends up at 5.5 to 6, which is where the market prices are at, it's quite likely, given that the UK economy has a fair amount of debt, we have a fair amount of mortgage holders who will be refinancing into higher rates. That is likely to cause a significant decline in demand, as they'll be spending more of their monthly paycheck on the mortgage than in the local economy. So it's just a matter of time, I think.
Yeah, but there's an interesting point in there, isn't there? Because I guess the Bank of England's tool to counter inflation, which is their primary task, you might argue, is that an increase in interest rates. So they will, they might be aware of what's going on economically, but all the time those inflation figures come out as being outside their target, they will seek to increase interest rates. Interesting that the Chancellor then goes about sort of speaking to the mortgage companies and saying, look, you've got to be sympathetic. Are those two things competing against? Should we be biting the bullet and accepting a recession, or is there a natural frisson there that is beneficial to the wider economy, that the two trade each other off a little bit?
It's a really good point. They definitely do. They are somewhat in contradiction with one another. There's a trade-off there, and the more that we allow people to defer mortgage payments or avoid going bankrupt because they can't pay their mortgage interest, for example, the more that we're kicking down the can down the line for another generation or another year, or most probably for another government. The Labour government will probably be the ones who have to pick it up. But what it means is that there will be more money in the economy because people won't be paying their mortgages, etc. So there'll be more money to spend, which is going to keep demand elevated. And I understand why politically it's very insensitive to allow people to go bankrupt and have to give up their homes. That's a horrible, horrible thing. But from the Bank of England perspective, it is also a bit of a challenge because it's not really helping with the inflationary battle that they have at the moment. So it'll be interesting to see how that plays out. What I would say is what they're doing in the US at the moment is that they've done what's known as a pause or a skip. So the most recent policy meeting that they had, they decided to not raise interest rates, and they've decided to skip until the next meeting, and then they'll assess the data for another month. They'll have a bit more information. They'll have a bit more of a chance to kind of appraise whether the impact of higher interest rates is really having an impact on the economy. And I think that at some stage the UK will have to do the same thing, and they'll have to just say, hang on, are we getting into the territory that we're over tightening, we're making things overly restrictive, and that the worst scenario that they have to do is that they tighten too much, we have a recession, and then they have to cut interest rates too much, and then you end up with this kind of stop-go policy of tightening a lot and then suddenly cutting a lot and then having to tighten. And it means that it's very unclear. It means that policy becomes very kind of contradictory, and you end up kind of moving from one setting to another. Actually, sometimes it's better to let it rise, have a period of assessing the data, being data dependent, and then being able to make kind of considered, calm decisions rather than being flip-flopping here and there.
So if we look at it, against this background, this has been raging, let's say, all year and longer, as I said right at the beginning. If we think of stock markets, certainly that's what people listening will think of in the first instance. They have shown some resilience to this. So I guess if we look at the main markets in the UK, the FTSE 100, for example, fairly flat over the course of the year. Some of the US markets showing reasonably strong gains, so quite a lot of resilience there. I guess that's linked to what we've been speaking about. There was an expectation that interest rates would go up and that inflation might hang around for a little bit longer. People might be worried about the word recession leading to significant stock market falls, and I think that's understandable and I guess still possible. But actually, the market so far have showed quite a lot of resilience. Is there any sort of key reasons to that? Corporate earnings, for example, holding up more than anticipated?
Yeah, it's been a great kind of contradiction this year in that all of the laggards, or most of the laggards from last year, are now doing very well, and most of the winners from last year are not doing quite as well. And a good example of that is the FTSE's flat, and that was one of the best performers last year, whereas the S&P 500 is up around 13% in local currency terms, Nasdaq's up around 28% in local currency terms. So they've done very, very well. And you're right, earnings have been much more resilient. If we take the most recent earnings season, they were expected ahead of the earnings season to decline by around 6 to 7%. In the end, they were down 0.5 to 1% or so. So much more resilient than people expected. And clearly, there was a lot more money in the system post-COVID. COVID in the US, where they handed out stimulus checks, or in the UK, where we did furlough, that's meant that the consumer clearly had a lot more fat on the bone, as it were, meat on the bone, to be able to kind of withstand these higher interest rates. That they're much more able to kind of keep spending through these periods of tighter policy. And corporates as well also have a bit of extra cash. They've been able to raise their margins to offset the impact of higher energy prices. So that's been really encouraging. The gains in the S&P, but also in Europe. Europe's done really well, and Europe's actually been a beneficiary of the China reopening, where you've had a lot of the luxury European goods manufacturers like LVMH, Louis Vuitton, Moet Hennessy, massive gains relating to the China reopening. So that's been quite positive. I think definitely economic, when we look at things like unemployment, when we look at the overall strength of the economy, GDP, etc., it's all been much stronger than people expected it to be. It has been obviously helped by the fact that we had low energy prices coming into the year. A mild winter particularly helped with that, because it meant that we didn't have to deplete as much of our natural gas reserves as people had anticipated. So a variety of different things ongoing there. And then obviously, I think the other thing to note is that the government support schemes, if you take the UK, for example, to help with the Ukraine crisis, an example of that would be the fact that they capped our energy bills. The impact of those support schemes was much more powerful than people expected in terms of the feed-through effect into the local economy. So it's actually been quite encouraging. The base case scenario that we have at the moment is that we think that there's a chance that in the US, for example, we will see a slight slowdown of growth. Whether that ends up being a technical recession or not, we don't think really matters, because if you're in the good, high quality companies, those businesses that have wide margins, that are very profitable, low debt, etc., we think that it won't really impact them so much. So kind of trying to avoid those economically sensitive businesses, those companies that are quite cyclical, and just keep investing into good quality companies. And we're actually quite positive about those companies, and any potential slowdown in wider economic growth shouldn't really impact them too much.
So if you listen to this, I guess got a very UK centric thing where we've got stubborn sort of inflation due to political issues as well as fiscal issues, those are unlikely to go away in the short term. But if we think of it more globally, where we would always encourage people to invest on a global basis, there are pockets of slightly more positive news in the fact that we got resilient markets, some ebbing away of inflation. And if I think about the US specifically, if they did enter into some form of technical recession and that inflation figure going away further, they've got the ability to reduce those interest rates in a measured way to offer some resilience. So some of those would be slightly more positive than what you might read in the daily spreads. But I guess the footnote to that, of course, is that that inflation does need to continue to go down. Otherwise, these interest rates are going to be around for much longer than people anticipated, and that's the main risk to markets just at this point in time.
Absolutely, and if you think about the Federal Reserve in the US, they've been quite clear that they don't want to make the same mistakes that they made in the 70s, where they allowed inflation to be much more pronounced, and it kept on coming back with a vengeance, and it caused this stop-go policy where they would raise rates, cut them, raise them, cut them. It meant that a whole decade of kind of real returns were wiped out by this inconsistent policy. They've been quite kind of clear that they don't want to make those mistakes again, and that they do want to bring inflation down and make sure that it's anchored down at that 2% mark. So we should expect tighter policy, but because of that, and I think that's a good thing, by the way. We want consistent messaging. We want a consistent policy. We don't want this flip-flopping, the stop-go policy, and that will help corporates because they can plan around higher rates, they can plan around lower rates, but it's very hard to plan around rates being up, down, up, down, up, down. No one knows what to do. But yes, very much more resilient. And what I would say is there are another couple of parts of the world where we are seeing slightly different policy arrangements. So in the West, i.e. the US and the UK and Europe, we're raising interest rates. Actually, in Asia and Japan and China, they're in a completely different cycle to us. They're cutting rates, or they're keeping policy settings quite loose and quite supportive. And so we're seeing some quite interesting opportunities in that part of the world latter half of the year. Valuations are very supportive, not just in terms of equity markets, but also in terms of currencies. So that we think as we go on later throughout the year, where the impact of higher interest rates start to have a kind of a grinding impact on the economy in the West, perhaps actually in the East, that might be where you start to see some diversified sources of return, some slightly different, some quite positive stories coming out of there as earnings growth increases, as you get a general trend of money start flowing back into Asia. That could be a really interesting kind of potential curveball for later on in the year.
Yeah, very much so, and yeah, supporting that statement around thinking about things in a global sense. But Henry, that's really valuable. Thanks very much for your time, and thanks to you for listening. Thanks very much.
Anytime, Roy. Thank you.